Imagine a person who earned $40,000 a year 5 years ago. They lived in a modest apartment, drove an older car, and understood their money completely. Every dollar had a clear destination. They knew where their next meal came from. Fast forward to today, and that same person now makes $85,000 annually. By every objective measure, their life has improved. Their apartment is nicer, their car is newer, their clothes are better. Yet something has shifted. They feel more anxious about money than they did when they earned half as much. They lie awake at night wondering where all the money goes. They can't save the way they expected to. They feel poor despite making more than they ever have. This isn't a story of irresponsibility or bad luck. This is the mathematics of lifestyle inflation, and it operates beneath conscious awareness. The core problem sits in a paradox that most people never articulate clearly. Income growth and financial comfort are not linear. A person making $50,000 might feel twice as secure as someone making $25,000. But a person making $100,000 often feels only marginally more secure than someone making $75,000. Sometimes they feel less secure. The relationship between how much you earn and how safe you feel about money breaks down at a specific point. And that breakdown follows mathematical patterns that are predictable and inevitable. Understanding these patterns doesn't change your income, but it changes how you interpret your own life. The psychological layer works like this. When income is low, every increase produces immediate relief. An extra $5,000 per year is meaningful when you're making $30,000. It might mean buying better groceries or finally having a small emergency fund. The psychological impact is enormous because the increase is large relative to your total. You feel it. But psychology doesn't scale linearly with numbers. The human brain processes percentage gains differently than absolute gains. A $5,000 increase when you're making $30,000 represents a 16.6% increase. A $5,000 increase when you're making $100,000 represents only a 5% increase. The absolute amount is identical, but the psychological registration is completely different. However, the mathematical part is where the trap actually forms. When income increases, expenses don't increase by the same percentage. They increase by a different mechanism entirely. Expenses rise through what economists call the ratchet effect. When you upgrade your living situation, you rarely downgrade. When you buy a better car, you don't go back to a worse car. When you move to a nicer neighborhood, you don't move back. These changes are sticky, they're permanent. They follow what researchers call an asymmetrical path. Going up is easy. Going down is psychologically painful and practically difficult. Let's walk through the actual mathematics. Suppose you made $40,000 per year and lived on $36,000, saving $4,000 annually. Your savings rate is 10%. Now you receive a promotion and your income rises to $60,000. You might think you'll save $24,000 per year, assuming expenses stay the same, but they don't. Instead, a complex negotiation happens unconsciously. You upgrade your apartment because you can now afford the better neighborhood. That costs $2,000 more per year. You buy a newer car because your salary justifies it. That costs $3,000 more per year in payments and insurance. You eat out more because you work longer hours and deserve it. That costs $2,000 more per year. You buy better clothes because your new position deserves presentation. That's $1,500 more per year. You start taking small trips because life is working out. That's $2,000 per year. Suddenly, the $20,000 increase in income has been completely absorbed. You're now living on $56,000 and saving only $4,000. Your savings rate hasn't improved at all. It's actually gotten worse because you're now making decisions based on a higher reference point. The mathematical principle here is called the consumption elasticity coefficient. It measures how much spending increases relative to income increases. For most people in developed economies, this coefficient is between 0.7 and 0.9. This means that for every dollar earned above current consumption levels, between 70 and 90 cents gets spent. Only 10 to 30 cents gets saved. The human brain is wired to find a new equilibrium. It's not a character flaw. It's a feature of how we adapt to environments. But there's a deeper mathematical layer. As income grows, the fixed costs in your life grow too. If you live in a more expensive neighborhood, property taxes increase. If you own a better car, insurance and maintenance costs increase. If you have a nicer apartment, utilities might be slightly higher, and you find yourself actually using the space. You justify subscriptions and services you didn't know you needed because they're small relative to your new income. A $15 monthly subscription seems trivial when you're making $100,000 annually. It's only 0.0018% of your income. But if you have 20 such subscriptions, that's $3,600 per year. None of them feel meaningful individually, but collectively, they absorb real resources. This is the mathematics of psychological invisibility. Small percentages compound into large absolute numbers. The systemic element amplifies this further. As your income grows, so does your access to credit. Banks offer you better credit card limits. You qualify for larger loans. Society essentially gives you permission to spend more. This isn't accidental. Credit systems are designed to expand with income because lenders have mathematical models showing that higher income earners have lower default rates. So the financial system itself nudges you toward higher spending. It's not malicious. It's just how the math works from a lender's perspective. What changes when you understand this? Your identity shifts from believing you're bad with money to recognizing you're experiencing a normal mathematical process. The feeling of being poor while making good money isn't a personal failure. It's the predictable outcome of how human psychology and economic systems interact. It's not about willpower or discipline. It's about understanding that income, growth, and financial security are decoupled unless you actively break the connection. Most people don't. They earn more, spend more, and maintain roughly the same level of financial anxiety. The numbers change, but the feeling stays the same. It's a treadmill that accelerates without ever reaching the destination. The mathematical reality is this: building actual wealth requires decoupling income from spending at some point. It's not about earning more. It's about consciously deciding that your consumption elasticity coefficient will be different from the population average. Instead of spending 75% of your raises, spend 50% or 40%, or some deliberate percentage you choose rather than allowing unconscious lifestyle inflation to choose it for you. This is mathematics you can control because it's a ratio, and ratios are under your governance once you make them visible. The trap only works when you don't see it. When you understand the math, you become aware that your spending is a choice, not an inevitability. Understanding this doesn't mean deprivation. It means recognizing that the feeling of being poor while making good money is real, but it's created by invisible mathematical forces, not by a shortage of actual income. You're not failing. The system is simply designed such that income, growth, and freedom don't track together unless you actively intervene. And that intervention starts with seeing the mathematics clearly. Once you do, you're no longer swimming against an invisible current. You're swimming with full awareness of the water.